If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
Hello everybody, it's Tortoise Investing coming at you today with something pretty interesting. Stick with me here. We all love Schd, or most of us do, and we are aware that it does its reconstitution once a year where it does it adds and gets rid of new positions. What if I was in charge of that? I got 3 positions that I would remove, 3 positions that I would add, and I've also just, got some percentage things based for you. Something a little fun, start the Monday off. If you're new, hit that subscribe button for more. Hit that like button, comment down below. I would greatly, greatly appreciate it. Any and all support means a lot. It's super free and just super easy to do. It means the world. But without further ado, let's go ahead and take a look at Schd. Most of us are aware of this. If you are not, Schd is the Schwab US Dividend Equity ETF. Expense ratio 0.06, pretty low. Dividend yields 3.17%, 3.71%. It's got 102 total holdings. So this right here is what makes up the top 10 of Schd. And the last reconstitution that they did, I was like, God, man, I wish I was in charge of that. Why not make a video about it? So if I could change right now, if they told me pick 3 positions to add, 3 positions to remove, what are you doing? This is what I'm doing. What I'm removing Chevron. 4.2% total allocation in the portfolio. I'm removing Verizon. 3.91% total allocation. And I am removing Ford. I would like to find the man that thought that this was a good idea. Because it's not. I know there might be some people out there like investing in it. No. Not that personal opinion. Bad company. So that makes up a total of 9.72% that I would change with SCH. It's pretty significant for just 3 positions. So let's take a look at them here through Qualtrim Insights. The 3 that I'm changing, the 3 that I'm adding. Ford, there's just not too much here to love. Dividend, a little bit all over the place. EPS, as you can see, is just all over the place. The free cash flow is, again, all over the place. And it's not really growing any. It's the thing with automakers and car companies. You don't see any growth. It's just kind of there. It's just so unappealing. I know I'm like roasting Ford right now, but like return on capital, it's not. It's all over the place. There's no predictability with automaking companies, unless you're Tesla. And I don't know. It just why they suspended their dividend for a little bit during the COVID, and I just I don't get it. I don't like Ford. Next one I don't like really all that much is Verizon. I personally think this is a value trap. You're paying for high yield. Very similar situation with Ford, though. Your growth's kind of stopped. It's not really went anywhere for 8 years. It's just kind of there. Let's take a look here, 5-year chart. Yeah, this is kind of going up. Not really. Free cash flow, last 5 years. Yeah, this is not good. No, I don't. That's the thing with telecommunication companies, and the reason why I kind of stay away from them. There's just not much really there. 5-year chart going nowhere. Let's take a look at Ford's 5-year real quick. Yeah, I mean, there's a little bit, but not much. But it's kind of a similar situation. You have some EPS growth, I guess. It's supposed to be something that raises its dividend pretty aggressively, as CHD is, this isn't going to help you. Look at Ford's, the thing with the dividend there. This ain't helping you. This is, well, I don't even know what this is. This is everywhere. Yeah, I'm not a big fan of telecommunications. I don't think that they are helpful to SCHD, especially at the highest allocation that they're at. You might be thinking, well, it's so that you get the higher yield, you get the higher payout. I got that covered with my planned reallocation. Check it. Okay, and just final look, return on capital. And again, it's not really growing. It's a little bit better forward, but it's still not really going anywhere. Next up, this controversial one people might not like, Chevron. I'd get that out of there because I don't see a future with energy, and energy is so volatile. It's up, it's down, it's all around. You have good years, bad years. And if I was going to run an ETF, I would want consistency. Consistent growth, consistent free cash flow coming in. Take a look at the 5-year chart. Yep, down, up, down, up, down, up, down, up, down, up, down. Just all over the place. No. Revenue, same story. Up and down. It's like a roller coaster. Free cash flow, it's growing. I mean, it's a big old oil company. Of course, they're going to be making that Schd. EPS is some kind of, it's a little bit, it's all over the place as well. The dividend is slowly increasing, I suppose. Again, I don't see there being a big future for it. And it is so volatile and all over the place, I wouldn't have it in an ETF, especially at that high of a percentage. And just the return on capital, there's some good years, there's some bad years. Yeah. What I would replace these three with, and like I said, they make up 9.75% of the portfolio. To make up for some of the percentage differences here with the yield, I would throw 3% into Starbucks. Take a look at it here real quick. Now, this is a fine looking company. We got a good dividend yield, 2.5%, sustainable payout ratio below 70. It's pretty nice. Revenue growing. Free cash flow slowly growing. EPS growing. It's got manageable debt. Oh yeah, very manageable debt, 11.8 billion. EBITDA is 6.2 billion. Dividend's been increasing at a rate of 18% over the last 10 years. So you're going to have that dividend growth. So you can keep pumping out that 10% plus dividend growth with your ETF. They are doing share buybacks, which is very nice. You'll see a lot of these were diluting you like crazy. And the return on capital employed, they had their little hiccup there, and their hiccup back in 2013. But it's reliably around 15% plus, and you love to see that. A good return on capital employed is just, you can't underplay that. And this is 24.5. Company's doing very well. Next up, I would add Texas Roadhouse. Free cash flow yield of 2.71%, dividend 2.2%, 46% payout ratio. Again, you're looking for consistency. Look at that revenue growth. Look at the free cash flow. You know what else is going to look very similar to this? The EPS, just up and to the right. And they have very little debt, so there's no risk with this having this in your portfolio for your ETF. The dividend's been increasing at a rate of 16.44% over the last 10 years. Again, you're getting some rapid growth, which will help you pump out that 10% plus that you're doing with your ETF. Return on capital employed, again, very similar situation with Starbucks. This thing's been 13 plus to 17 area for forever and a day. 2020 hiccup, everything had it. And share buybacks, they're doing them little by little. Again, you don't want companies that dilute you. Look at Ford. Look at this. You're getting diluted. Look at Verizon. You are getting diluted. When you own these companies, you are getting a littler and littler piece of the pie. Can't stand it. And lastly, I would add 3% as well into Tractor Supply. 3% in Starbucks, 3% in Texas Roadhouse, 3% in Tractor Supply. Let's take a look at it real quick. 2.69% free cash flow yield, a little bit over 2% dividend yield, 38.9% payout ratio. It's a very similar situation for the rest of those. Consistent revenue growth, consistent free cash flow growth, consistent EPS growth, a strong growing dividend, 23% over the last 10 years. They're buying back their shares. Look at that. Very nice. Return on capital employed has been 18 plus for forever and a day, and it's growing. And you might thinking, well, you got 3% there, 3%, 3% Starbucks, Texas Roadhouse, and Tractor Supply. What are you doing with the other 0.75%? Well, what I'm doing with that other 0.75%, I'm throwing it in Altria. I'm just going to throw it in there. Altria, you know, they've got things figured out. They've already said they're going to consistently grow around 4% with their dividend every year. And it's already paying around a little over 8%, maybe even 9% dividend yield right now. So I throw the 0.75% in there. It would make out for some of the yield that you're losing with here. And the growth that you're getting along with these dividends would easily make up for what you're sacrificing with Chevron with 3.5%. Like, that's what I would do. That's personally, if I was to reconstitutionalize SCHD, that's what I would do. Let me know what you would do down below. I'd like to hear from you. It'd be interesting to see everyone's thoughts on it. But yeah, make sure you hit that like and subscribe button for more. And until next time, see yous.